incredible developments on the US economy, how it all matters for Bitcoin, and my new idea to split the US dollar into two instruments. Welcome back to the Bitcoin Layer. I'm Nick Bhatia. I'm happy to announce that I have finished writing my book, Bitcoin Age, and the release date is officially set for March 11th, 2025. Now, in the coming days, I'll be releasing the book's description, but I want to share with you guys something that I left out of the book. It's an idea that I've been working on for a long time. It's the idea to split the United States dollar between the eurodollar system and a new national currency. So I want to unpack it a little bit. The reason that I didn't include it in the book, too complicated, and it doesn't matter for the Bitcoin age. That is a United States of America story. I am excited to work through those ideas with you all. Make sure you're subscribed at thebitcoinlayer.com/subscribe, where you can become a TBL Pro and gain access to all of our written research. So we'll get to the idea of splitting the dollar later in the video. First, I want to discuss a lot of items that are impacting Bitcoin, but specifically the Treasury market and the future of the US economy. All right, guys, I have 11 topics here before we get to the dollar split, but it all builds, so make sure you keep watching as Bitcoin's role in the global financial landscape evolves. Understanding its potential impact on your wealth becomes increasingly crucial. Whether we see a measured adoption or accelerated hyper-Bitcoinization, being prepared for various scenarios can make the difference between merely participating and truly optimizing your position. This is why Unchained developed the Bitcoin Calculator, a sophisticated modeling tool that helps you visualize and prepare for multiple Bitcoin futures. Beyond traditional retirement planning, it offers deep insight into how different adoption scenarios could transform your wealth trajectory. What sets this tool apart is that it's integrated with Unchained IRA, the only solution that combines the tax advantages of a retirement account with self-custody of Bitcoin. In any future state, maintaining control of your Bitcoin keys remains fundamental to your Bitcoin strategy. Explore your potential futures at unchained.com/TBL. Don't write your seed on paper. It's estimated that so much Bitcoin is lost forever, and the main culprit, the main reason is poor seed phrase security. This is why we use Stamp Seed, a DIY kit that enables you to hammer your seed phrases into titanium plates using professional stamping tools. These plates are heat resistant up to 3,000 degrees, fireproof, crush-proof, and time-proof. They're compact and easy to hide, and they can be used in your single sig or multi-sig setups. Make sure you go check them out today at stampseed.com and use code TBL for 15% off of your order. Let's start number one with productivity. Productivity is a concept in economics that refers to the efficiency of producing goods and services. So a company with the same amount of capital and labor can produce X amount of goods and services today. If they're more productive, they can produce more tomorrow with the same amount of labor and capital. If productivity rises, even if we don't get credit growth or demand growth, we can still have growth in the economy because we are producing more with the same amount. So that is an important concept, and that should be held at the front here when we think about the economic agenda of the new administration. They want the US economy to grow. They want to make the US economy strong. And so in that effort, they're going to target productivity growth. So when we hear the Vance speech on technology, AI investment, what those things will do is help a company produce more with the same or produce the same with less. That is productivity growth. If they produce the same with less, yes, it means some people lose their job, but they lose a job that has now been replaced by a more productive process. And so in that job loss, you look for the economy to award that person, after retooling, reskilling, a new job in the more productive economy. That is the evolution of productivity. That's the life cycle. And we have to keep that at the beginning. So if productivity is one source of that growth, what is another source? More lending. Now, we have our TBL liquidity framework. People can go to thebitcoinlayer.com/subscribe, become a TBL Pro. You get our reports called Mean Median Mode. It's our quantitative report going through every number you need to know in Bitcoin and global macro. We have our weekly update as well, in which we go through TBL liquidity in both of these reports, the changes, and what is the sentiment for risk markets. That is what our metric is all about. We have over a 70% correlation now with risk markets on a trailing 12-month return basis. So we really want to think about what drives liquidity, what drives risk assets. It's in TBL liquidity. There are 4 components: the size of the banking system, interest rates, bond volatility, and the US dollar. Those are all inputs to how risk assets perform, including Bitcoin. The first component, and actually the base of the entire model, is the size of the banking system. Why is that the case? Because banks are the financing mechanism and the money creation mechanism for credit growth. If banks don't have the asset growth, they will not have lending growth. And so lending growth is what leads to greater aggregate firepower from the economy to spend. And money lent is mostly spent into the economy. And so when we get a credit expansion, whether it's the government printing a lot of money in terms of borrowing in the deficit market and issuing T-bills that then the banks buy and expand the credit system, or if it's the private sector, and that is much, much more important to the economy, the private sector borrowing and investing and spending on things like factories and hiring. Right now, you will not see this massive hiring wave yet. You're seeing an investment wave. It doesn't mean that the jobs numbers are bad. On the aggregate, they still look good. We have ISM services and employment. We have ISM services and ISM manufacturing, both employment sub-indices in expansion territory. So job market doing okay. But when we think about the drive to productivity right now, it's not building a brand new factory for the rest of the economy. It's buying AI tools. For the big tech companies, they are the ones that are going to be doing that big borrowing from the market and the credit expansion of the whole system. Why does big tech need to invest? They need server farms. They need software developers. They need to buy AI startups and basically take their technology, everyone who is innovating in this arena. And so when we think about the big tech borrowing, banks lending, that will grow the system. All right, third point, deregulation. Now, this goes back into productivity. If you think about doing more with the same, a regulation going away will actually allow productivity to grow, because you don't have that one extra person for compliance. And that's just the basic example here. When regulations go away, productivity can increase because you're not spending that time and money trying to comply with the regulations themselves. You can go out and produce the good or service, or fire the compliance officer and then hire a new worker, therefore spending the same amount on salary, but now you're producing more because you have one more person on the assembly line, as opposed to somebody legal or just trying to perform compliance. Now I want to combine point 2 and point 3, lending and deregulation. And that seems to be the path and the avenue that the White House wants to unlock. They are going after the Fed right now, and they have even come out and said the Fed has been completely irresponsible in their management of bank regulation. They're either over-regulating or not regulating correctly. That the Fed needs to be replaced by the Treasury Department in terms of regulating banks, but read between the lines, deregulating banking itself and taking it maybe away from the Fed. This is a big idea that I didn't see coming. I haven't seen a lot of this stuff coming that has happened in the first 3 weeks of this administration. It's been an absolute blitz, and for all of those that are headline watchers or even people that like to read the news, I'm sure that you are as out of breath as we are. So when I think about deregulation and bank lending and the new administration trying to tap into that animal spirit that they believe is right there under the surface, if they can just remove some regulations, either on the industry side, and it's actually both, on the industry side and on the lending side. So the guys tweeting about washing machines and shower heads and water regulations, but that's just the surface of the first move. What is the second move? You always have to think marginally, what is the next thing that's going to happen? Well, the next thing that's going to happen is that some guy is going to call his contractor and say, dude, we can now put the proper shower filter and let the water run that we always want. Come over. And then you multiply that times 1,000, 10,000, 100,000. People get jobs. They come in, and guess what? The contractor says, I need more inventory of these new shower heads that don't have the low flow restrictions on them anymore. How am I going to buy them? They go to the bank. The bank says, I'll finance you. So then the contractor goes to the producer. The producer says, well, I haven't made them yet. Go to the bank. The bank says, sure, I'll lend you the money. Do you see how the deregulation can snowball? And so that is the motivation for the productivity growth itself, is that if you can get deregulation on industry and you deregulate the lending, you allow the bank to say, yes, I will lend to you here, I will lend to you there. The bank is happy because the bank is extending loans to producers that they believe can pay back, that won't default. So the bank is happy, industry is happy because industry can grow. And the second, third orders of effect, which are potentially increased spending in the economy because you have more wealth, may lead to increased prices, but we have an increase in productivity. So what do you also have? You have an increase in supply. So don't just make the leap that aggregate prices will go up or down because of one thing. We have to let it play out, and I'm just not smart enough to predict 3, 4, 5 orders of effect. What I do know is that the United States of America is in a trying mode, and they are starting to try different tactics to try to get growth up and potentially the debt burden down, which we will get into here toward the end of the video. Now, how does this matter for Bitcoin? You guys know, if you've been watching and listening, the Bitcoin thesis right now is highly dependent on credit creation to avoid this deep bear market cyclicality that Bitcoin has been used to for its 16-year history. Okay, every 3 or 4 years, we spend 2 years in the gutter, basically surfing along realized price, which today is about $42,000. That doesn't have to be Bitcoin's future, and I'm starting to believe that it won't be, especially as we get into more lending with Bitcoin as the collateral. You basically then have a situation in which the floor for Bitcoin is much higher than it would have been otherwise. Let me explain that. When we went from $70K to about $15,000 in November of 2020, or over the course of 2022, but then in November 22, Bitcoin went below 20,000 and actually went below the previous all-time high from 2017, which was right under $20,000. So on a 5-year time horizon, Bitcoin was negative for a few days. What was going on during 2022? Obviously, we had a chain reaction of bankruptcies, defaults, and frauds being exposed. 3AC, Voyager, FTX, Genesis, all getting wrapped up in a combination of fraud and mismanagement. The fraud coming directly from FTX itself. But what you didn't have are banks that are willing to step in and lend money to a financial participant that says, hey, I think 25,000 is the bottom, and I want to buy $1 billion worth of Bitcoin if it gets to that. So you have these embedded limit orders backed by credit creation and bank lending and the bond market in Bitcoin today that I don't believe have ever been there before. So I do believe that the floor of Bitcoin is, all else being equal, higher today than it was before a lot of this collateral acceptance started to permeate the market. And it started before the Trump wave in October of 2024, about 3-4 weeks before the election, when markets started to price it in. Now, it started, of course, with Saylor. Saylor set the example, but then we heard the rumors, Middle Eastern sovereign wealth funds buying that open secret of that huge buyer out of the Middle East. And what you saw is that there was a legitimization of large Bitcoin positions at the top levels, the top investors in the world. We know that the Norwegian Sovereign Wealth Fund is an owner of several equities that own Bitcoin on their balance sheet, including Strategy, formerly MicroStrategy, MetaPlanet out of Japan, and Mara, here in the United States, a Bitcoin miner. So we know that this institutional adoption, I'm remembering the Michigan and Wisconsin state pension funds that got involved in IBIT early. They were some of the first investors to pop up on the holdings page on Bloomberg. So we saw all of that happen before we knew who was going to be president in November of 2024 or toward the end of October. Now, then you get the election and you get the sudden reversal of a lot of the burdensome regulations on the industry. Obviously, the debanking that was going on. Another reason why the administration is attacking the Fed's role in what was going on against the Bitcoin industry for the last couple years. All of this builds up to an environment in which investors can buy Bitcoin, are not afraid of laws that will come down that will be punitive to them if they buy Bitcoin. Now you have tax considerations that are starting to become more balanced or more favorable for Bitcoin positions. All of this will encourage banks to lend money against Bitcoin collateral, which the regulations are already starting to come through toward guiding banks toward letting them do that. All of this supports a much higher floor for Bitcoin in its historical cyclical behavior. It's something that we must take into account, and the stories are changing every day on the regulation front, but I really am watching every single headline to do with bank regulation, Basel III, the implementation of global banking standards in the United States, how much the US is going to go along with the Basel III regulations versus hold out. There's a lot that I don't know about Basel III. So my homework is cut out for me here over the next few months as I hone in on banking regulation, specifically how deregulation can lead to more lending, specifically how banks will operate if they're not regulated within the Fed's current framework and have some new framework that they can operate under from the Treasury Department. All of these things are important to watch. Point 4, the Department of Government Efficiency. So an incredible development here in the United States. We have Elon Musk heading up a team of 5 very young computer engineers that are coming in to these government departments and basically getting all the data bubbled up to the top in terms of where the money is going. We have heard some wild stories that we don't have to get into right now, but you guys should look them up, what has been exposed there at USAID, as well as what other departments is he going to get into. Now, this all ties back to the Treasury market because money spent today and over the last 25 years, money spent is money borrowed because we've been in deficit for the last 3 decades. So money spent is money borrowed. Money borrowed are treasuries issued. Treasuries issued are higher supply, and higher supply, all else being equal, is lower price, leads to lower price. And of course, lower price is higher yield. So for the Treasury market, what the government spends matters a lot. And if the government is now going to spend less or cut expenses, that is a net positive for the Treasury market. Now, when we think about how many treasuries are hitting the market every week, every month, the aggregate amount goes up and up and up because every month we're in deficit. Every quarter we're in deficit. We're not going more than a few days without cash actually draining from our account, making us have to go and issue more debt to fill that Treasury general account back up. Now, what if all of a sudden we're spending less today than we did yesterday? Well, the cash balance goes down at a slower pace, and the amount of treasuries we have to issue goes up at a slower pace. So all of those things matter a lot for interest rates. They matter a lot for not just interest rates, but the debt to GDP of the United States government. Remember, the government has a GDP of 30 trillion, but the debt is around 37 trillion. So the debt to GDP is about 125%. If the economy can grow to 40 trillion, but debt only grows to 40 trillion, that you've lowered the debt to GDP and you've increased the fundamental financial position or decreased the leverage of the country itself. That is material. It matters for the Treasury market. If the Treasury market is healthier, credit creation can actually accelerate under those conditions. So when we think about why so much focus on Elon Musk, because the Department of Government Efficiency translates directly to the Treasury market through the spending channel. It matters so much, and it's just getting started. One of the things I've been thinking about is when Elon gets his guys into Medicare and he actually sees how CMS spends that money. I can promise you from personal experience, it is going to be lit. Just wait until Doge gets at Medicare. I can't even tell you what they're going to find because we'll just all have to find out for ourselves. One of the other very, very large line items is the defense budget. Now, I have no knowledge on how much money is wasted within that defense budget. But what I do know is that the administration is looking at any technology that can be employed for less money. So when we think about productivity, this is the exact example. You have defense contractors doing something for X amount of money when it could be done for less. And that is something that we will go one department at a time. The Department of Government Efficiency, I recently found out that it was a different agency. They changed the name so that they didn't have to start a new agency. Okay, so it was called the United States Digital Service. It was started by President Obama in 2014 with an executive order, and the administration repurposed the acronym as the United States DOGE Service. So instead of digital service, DOGE Service. The original goal was to provide IT consulting to parts of the government. So they have used this department to completely upend the very idea of a United States deficit, tax revenue, expenses, everything. They're starting from scratch. I'm smiling because the next point that I want to talk about after Medicare and Defense, the sixth point, is the IRS. Now, I believe more than ever he wants to get rid of the IRS. It's not something I could have predicted or that I saw coming before this administration started. But now with the External Revenue Service and the idea of the sovereign wealth fund, my next point here, the ending of the IRS for the first time is well within the conversation. I think that is absolutely fascinating. Trump tells us that he's convinced they can get the revenue from the External Revenue Service. I don't know if he actually believes that or if that's just another negotiating tactic, but I see the sovereign wealth fund, my seventh point here, the sovereign wealth fund being a potential revenue generation tool for the country to supplement their revenue in the absence of the income tax. That is something that is unforeseen. It's almost a foreign concept, but we will have to work through it as more details come out. We'll talk about Bessent here in a second. It does look like Bessent is in charge of the Sovereign Wealth Fund. I saw him say we're going to stand this thing up in 12 months. He thinks that they're going to be able to get something going soon, and I have something on Bessent here in a second. Quickly, on the Sovereign Wealth Fund front, from the Bitcoin perspective, Bitcoin is a perfect asset for the Sovereign Wealth Fund. Whether a strategic Bitcoin reserve is related to the Sovereign Wealth Fund is yet to be seen. I don't even think they know any of these things yet, but we will be getting more and more information every single day, as this is the fastest clip I've ever seen any government department work ever in my entire life. If any of you have been to the DMV, you know exactly what I'm talking about. Now, let's go to my eighth point on Canada. Is he serious about the 51st state? I don't know. I don't know if that's just art of the deal or if it's something that he actually wants. What I do know is that he wants something from Canada. So, TBL is going to publish something today from our TBL Thinks series on the Canadian tariffs. These aluminum tariffs are really targeting Canada specifically. They're reminiscent of 2018 tariffs, but we had a lot of exceptions. This time around, it seems like Trump wants to play tough with Canada. Canada is not caving. They're actually doubling down. They want to expand their presence in the Arctic. So there's a lot of jockeying right now, and we'll have to continue to watch the Canadian situation. But what I will say is that on the 51st state issue, it does seem to be motivated by something material. Now, a headline before I started recording, Scott Bessent being sent to Ukraine on the rare earth metals front. So this ties back into the sovereign wealth fund. Is Trump out to just cut a bunch of deals around the world to get assets into the sovereign wealth fund for the United States? I don't know, but sending Bessent to Ukraine is something that really raised my eyebrow, because if Putin and Ukraine are going to strike a deal, there's some land concession there. Well, who's going to own that land? Who's going to own the minerals underneath the ground? These are things that it does appear the United States wants to get involved with. So another thing that we will have to watch very closely, but keep in mind that Bitcoin Reserve, Canada, Ukraine, these are all being positioned in a way that the sovereign wealth fund can then take advantage of. Brand new concepts for the country that we will have to work through. So the 9th point there on Ukraine, 10, really quickly, before we went live here recording, we saw a headline, Kash Patel likely to be confirmed and possibly going to release the Jeffrey Epstein client list here in the next few days to weeks. That is something that we've been watching here as a channel for a while. Why? Because a lot of these people that are supposedly on these lists are in the banking sphere and have tie-ins to what's going on in banking. So something that we will be watching very, very closely. Okay, now we've talked about the Treasury market throughout. So let's summarize why all of these things matter for the Treasury market. Less spending means a stronger Treasury market. Less spending, more government efficiency means less tax needed. Less tax needed means could they get rid of the IRS? If we have less revenue, less expenses, we have a smaller and therefore a more scarce Treasury market, given the amount of capital around the world that is dying to get a piece of the risk-free asset if it is in a good position to hold its value. Now, the only way that the Treasury security itself can hold its value is if it's not just printed and printed and printed. So how can they support the Treasury market? A more efficient and more productive government. From the government's perspective, we don't want them to stay the same size and produce more goods and services. We want them to produce the same amount of benefit for less and less and less. All right, we finally reached that point in the video that I want to talk about my big idea of the dollar split. Now, I'm really excited for you guys to check out Bitcoin Age. I've been working on it for 2 years now, a year plus on the research front and a year plus writing it as well. The story of Bitcoin is about the expansion of the credit system and the juxtaposition of Bitcoin to that never-ending expansion of the credit system. In that story, as I was searching for the ending, I had this idea to reinvigorate the US dollar. In the end, though, it didn't make it into the book because it's not Bitcoin's story. It's the US's story. So the story that I'm going to tell in the book is a Bitcoin one, but I have an idea for the dollar that I want to explain to you today. Now, the idea is to take this eurodollar currency that is created outside of the United States and make sure that the banking system has to qualify it as a separate currency from the US dollar. Then you allow the US dollar to, then you disseminate a new national currency, a new US dollar throughout the United States. So you allow people to convert their banking deposits held onshore at US banks. You allow them to convert it 1-to-1 for a new US dollar, and it will likely be a digital currency. And the most important thing about this is that it has nothing to do with the Fed, because the Fed administers the global banking dollar. Yes, it is the backstop for the commercial US onshore banking dollar, but it also is the backstop for the eurodollar system through its system of swap lines. So you really do have today's dollar is a global banking dollar because it can travel around the world and it can be issued outside of the United States. But what you do have onshore, you have US Treasury holders and you have deposit holders that have FDIC insurance. So these are onshore dollar instruments that are guaranteed by the federal government. You also have all these onshore money market funds that are regulated by the SEC and are legally required to own X amount of treasury bills that mature in 1 day, 7 days, 30 days, and they have to have X% of their portfolio in either treasuries or repo that is collateralized by treasuries themselves. So you have all these onshore dollars that are real dollars. If we allow people to exchange those dollars for new national US dollars, we can institute a new national currency that breaks free from the Fed's global banking dollar. Now, hopefully you guys can see that this idea is absolutely crazy and nearly impossible to implement, which is why it didn't make it into the book. It was way too hard to describe because it is such an out there idea. But I wanted to share it with you, especially because it's not making it into the book. Get the conversation started. Is this an idea that makes any sense? Is anybody else talking about this? I'm curious. Make sure you go to thebitcoinlayer.com/subscribe and become a TBL Pro today. We are trying to add a lot of value to your process with all of our quantitative reports, letters, and opinions, including our monthly Zoom Q&A available to TBL Pros only. We'll catch you guys next time.